Hi there, this is Brodrick. You probably know that I'm bullish on precious metals, but I'm not bullish on most other commodities, at least in the short term. Let me give you a few reasons why. For one thing, the American Association of Railroads estimates that about 30% of their boxcars, which is about 206,000 boxcars, have been placed in storage. Put end to end, these cars would stretch all the way from New York to Salt Lake City. Train cars aren't stored that way, of course, they're hidden in small towns throughout America. According to Union Pacific, one of the big players in this space, in normal times, that railroad would have from between 5,000 to 8,000 cars in storage. Now, they have 48,000 cars parked on 60 rail sidings around the country. So why are all these trains idle? Because they aren't carrying commodities around the country, whether it's iron ore or finished automobiles. And you know what else the trains aren't carrying? Grain. Take a look at the chart of the PowerShares DB Agriculture ETF. The symbol's DBA, and that's pretty much what everyone calls it. The DBA is composed of agricultural commodities including wheat, corn, soybeans, and sugar. Looking at the chart, you can see the DBA is breaking down. This does not bode well for grain prices. In fact, I would not be surprised to see the DBA go back and revisit its lows from December. This doesn't have to be bad news for commodity traders. For example, it's good news for my red-hot commodity ETF subscribers because they hold the PowerShares DB Agriculture Double Short ETN. Long name, call it the AGA. The AGA is moving higher as agriculture prices move lower. As bad as it looks, the DBA could be worse. For example, just look at the basic materials sector, as tracked by the iShares Dow Jones Basic Materials ETF, the IYM. You can see that the IYM is already breaking down from recent support. What's more, it's very close to challenging long-term support from November. If that support breaks, I don't know where the bottom is for the IYM. Do I expect things to get worse? Well, here are some examples of things I'm seeing. Number one, steel demand is falling off a cliff so fast that Credit Suisse warned that steel companies must consider shelving all growth plans as soon as possible if the industry is to have a sustainable future. Number two, automobile demand is plunging so badly that the turnover replacement rate in America's automobile fleet is now at a lower rate than in the Great Depression. It's so bad that Toyota is storing cars on container ships at sea because they've run out of room on land. It's so bad we could see car sales fall another 30 to 40% this year. Number three, and this is finally, 6 in 10 Americans are now worried that someone in their household will lose a job this year. People who are worried like that only buy the necessities, and that could have a real impact on the entire economy. I'll have more details on my outlook in a webcast that I'm doing for my subscribers today. Things do look grim, but remember, you can protect yourself and profit by investing in precious metals. You can also use inverse funds, like the AGA, to ride the market on the way down, just like my red-hot commodity ETF subscribers are doing. This is Brodrick. Good luck and good trades.